Hello everyone, welcome to my channel Risk Modeling Hub, your go-to space for mastering credit risk. In this video, we will be diving deep into the complete life cycle of credit scorecards. We will explore how scorecards are developed, how they are validated, and why both processes are crucial in managing credit risk effectively. We will dive deep into the complete life cycle of scorecards from development to validation. We will learn the key differences, processes, goals and challenges in each phase. So whether you are an aspiring risk analyst, a credit modeler, or preparing for an FRM exam, this video is for you. Let's start with the basics. What is a scorecard? A scorecard is a mathematical tool used by banks and financial institutions to assign a credit score to an individual or a business. This score reflects the likelihood of that entity defaulting on a loan. The score is based on predictive variables such as age, income, past credit history, and more. There are different types of scorecards: application scorecards, behavioral scorecards, collection scorecards. Application scorecards are used at the time of loan application to predict default risk. Behavioral scorecard is used for existing customers, focusing on payment patterns, credit utilization, etc. Collection scorecards. They help in prioritizing recovery efforts based on the likelihood of repayment. So what are the components of a scorecard? To understand the model, we need to know its components, such as input variables. These are the customer features that go into the model, such as age, gender, or account behavior. Weight or points, meaning each variable contributes differently to the final score, and these weights are assigned based on statistical significance, that is their predictive power. Score range. It usually ranges from 300 to 900. It is basically spread of scores, 300 being the risky and 900 being the safe. As you all know, higher the score means lower the risk. Cutoffs. Institutions set score thresholds to approve or reject loans. Thresholds above which credit is granted or below which it is denied. Odds to score. It is the relationship that establishes a statistical link between the score and the odds of default. For example, a score of 650 may correspond to a 15:1 odds of not defaulting. We can understand this a bit later. Let's move on to the next. So what is the scorecard life cycle? Let's understand with an overview of that. The scorecard life cycle has multiple phases: data preparation, scorecard development, validation and testing, implementation, monitoring, recalibration, redevelopment. So the data preparation means collecting, cleaning and transforming the data for modeling. Scorecard development is the actual modeling process. In validation and testing, we review the model quality. The implementation is all about deploying the model in production. Monitoring is about regular checks to ensure the model remains accurate. The recalibration means tweaking parameters to reflect updated data trends. And redevelopment, it means the complete rebuild of the model when it is no longer valid. So each phase is essential to ensure the model is not accurate at the beginning but continues to remain relevant. Now let's move on with the phase 1, which is the scorecard development phase. Let's break it down into the steps. Objective definition. Clearly define what the model is predicting. For example, the probability of default within 12 months. Let's say we have picked up this definition. Data extraction. Pulling historical data on customers and their performance, whether approved or rejected applications. Cleaning and transformation, which means handling missing values, treating outliers, and standardizing the variables. Variable selection, it means choosing variables that are predictive and make business sense. Next step is binning, which means grouping variable values into categories. WOE, which is popularly known as weight of evidence. It transforms bin variables to show how predictive each bin is. That is, it is a method of encoding categorical variables to show their predictive strength. Next is the logistic regression. It is a statistical method commonly used to estimate the probability of default. Next is scorecard scaling. It means converting raw model outputs to a score scale, say 300 to 900, which we discussed in the previous slide. Last is the reject inference, that is estimating outcomes for rejected applications to reduce sample bias. So what are the key techniques in development? There are various techniques we will discuss. First is the chi-square binning. It groups values based on similarity in default rates. Decision tree binning. It uses tree logic to find optimal splits in data. Weight of evidence. We discussed just now that it quantifies the predicted power of a bin compared to the rest. IV. Information value. It measures how much of a variable contributes to prediction. Model selection. Logistic regression, as we discussed, is a popular one, but ensemble techniques can also be used. But these are very much rare as they are black box models, so these are not much popular in comparison to logistic regression. The champion challenger concept. It is a technique to test new models against the current production and then chooses the best. So what is a model validation? Model validation is the independent review by a different team, often called model risk management. They ensure the model is statistically sound, performs well on unseen data, and is compliant with internal and regulatory policies. So for this, there are several key tasks assigned to them. They get started with reviewing the development documentation. They perform independent assessment conducted by different teams. They check the statistical soundness of the model. They ensure whether the model is technically correct and not overfitted. Out of time sample. Data not used during model development. That is, model should perform well not just on historical data but also on the newer data. Monotonicity. The score should move in one direction as risk increases. That is, default risk should consistently increase as score decreases. Types of validation. So there are two major types, qualitative validation and quantitative validation. So qualitative validation answers very important questions. Whether the methodology applied to the models are they sound? Are the assumptions documented by the developers? Is the variable treatment is applied logically or not? So I have summarized it into under four subheadings. First is the objective assumptions and methodology. Here, the validator reviews the model business purpose, underlying assumptions and logic behind variable selection and treatment. Next is data representativeness. Here, we check if the development sample reflects the current or target population. Time period, product mix and demographics matter. Next is regulatory compliance. It ensures whether the model adheres to internal policies, regulatory guidelines like RBI, Basel, IFRS 9 and proper documentation in place. Last is governance. Governance confirms all model development and validation steps are they being followed under the proper protocols. That is, whether there is version control, proper sign-offs and independent review. So these checks are important. There can be many other additional checks, but these are the primary checks which a validator must do under the qualitative aspects. Quantitative validation. So I have also categorized this under the four key steps. First is the discriminatory power of the model. It measures how well the model separates good versus bad borrowers. The higher value indicates better performance. So closer to 1 means better discriminatory power. The test falls under these can be AUC, KS, Guinea. Next, the check is the stability check. It checks how much the model's performance or input distribution drift over time. PSI helps track population shift risk. The tests that falls under are PSI, the Population Stability Index, and CSI, Character Stability Index. Next is the calibration, that is PD to actual comparison. It validates whether predicted default probabilities align with actual outcomes. Miscalibration can lead to wrong capital decisions and a huge loss. Last is the sensitivity and stress testing. It tests how the model behaves under stress conditions or changes in input variables. It helps assess robustness and risk under certainty. So, what are the key differences between development versus validation? So, I have prepared a table which clearly differentiates between what is the goal, perspective, tools and outcomes and the ownership in the development and validation. When it comes to goal, the development team builds the model, whereas validation team ensures their quality. In terms of ownership, development is done by the first line of defense, for example, credit risk team, and validation is done by second line of defense, for example, model risk team. The tools used in development can be SAS, Python, SQL, whereas validation often uses Python and Excel. For deliverables, the development team submits models, whereas validation team gives sign-off reports with challenges, findings, and limitations. So, what are the documentation requirements when it comes to the development? First is the data dictionary. It lists and explains each variable. Methodology: why specific models and techniques were chosen. Variable binning or WOE. Reject inference. It tells us how we deal with the rejected loan applications. Scorecard report. Final document with model details and results. What are the document requirements on the validation part? First is the validation plan. What tests will be run and why? Independent data checks must be there. Quantitative testing results we have discussed. Gap analysis and recommendation should come from the validation team. There also should be model approval memo, but that is the final sign-off document for the stakeholders. Implementation and monitoring. Once the scorecard is approved, the first step comes is the implementation, that is uploading the scorecard into the live systems. For example, loan origination. Next is the cutoff tuning, that is finding the best score threshold to balance risk and approvals. Third is the score distribution. How many applicants fall into each score band? Fourth is the vintage analysis. Tracking the performance of accounts by the origination date. Fifth is the default rate by score band. It ensures risk increases with lower scores. So when do we redevelop a scorecard? There are many factors associated with. One can be if there is KS or AUC score drop. The performance in the model declines over time. Or can be the population shift, that is change in the customer profiles over time. Macroeconomic shocks such as COVID-19 inflation or any unemployment spikes. Or there can be regulatory changes or significant policy changes that happen. Let's say the new RBI guidelines came up or the model assumptions are no longer valid, so new policy changes should be there. Tips for professionals. The documentation should be transparent. It makes validation easier, ensures compliance. Challenge model. Validators should test assumptions rigorously. Collaboration versus independence. Development and validation teams should talk but stay unbiased. Regulatory guidelines. RBI, Basel II or 3 or IFRS 9 all affect the model expectations. So one should stay updated with that. So what are the key takeaways from whatever we have discussed till now? Scorecard development and validation are distinct but interlinked. Both are critical for robust credit risk management. Each has specific roles and deliverables. Understanding both helps in end-to-end credit risk modeling jobs. So, is this video for you? Are you an aspiring risk modeler or FRM or CFA candidate? Are you a credit risk professional or working in fintech and NBFCs? Are you a data scientist who is working in finance and want to understand more about credit risk? Or are you a model validator and want to understand what can be the more checkpoints that I can perform on the model? So this video is right for you. What can you expect on my channel in the upcoming videos? We can discuss the scorecard basics and more about the application, behavioral and collection scorecards. We can understand on how to read and interpret a credit risk model report. We can also understand the key differences between logistic regression and decision trees using an example, and that too in the Python. We can also understand the reject inference in simple terms using an example. We can also understand top 5 mistakes in model validation and how we can avoid them. Also, I can tell you the difference between credit score versus risk score. What's the difference between that? So let me know in the comments what you want in the next video. So scorecard development and validation, these are the two sides of the same coin. A well-built and well-validated model improves decision making, lowers risk and ensures regulatory compliance. So that's all for today. If you found this video helpful, don't forget to like, comment your questions and subscribe for more content on the topics that we discussed, and if any other topics that is coming into your mind related to risk modeling, scorecards, ECL and finance careers. So thanks for watching my video and see you in the next one.